Imagine this. You've maxed out your credit cards. Then, to pay that debt off, you somehow lend money to yourself. Sounds illogical, right? A cycle that would bankrupt any person within months. Yet the most powerful state in the modern world finances itself with a system remarkably similar to this. The United States raises money by issuing bonds. In other words, by borrowing. Then a significant portion of that debt is purchased by its own central bank. On paper, it looks as if the country is paying itself with money it doesn't actually have. In reality, however, this arrangement is not just an accounting trick. It is one of the foundations of the global economy. The real question is not whether it is clever, but how long it can continue before confidence breaks. Let's start from the basics. A government bond is essentially a promise of debt. The government tells the investor, "Give me money today and I will repay you later with interest." These securities are considered safe because they are backed by the full payment capacity of the US government. Investors have believed this for centuries. That is why the United States can keep spending more than it collects in taxes and still find lenders. This model is not new. After the Revolutionary War, America was buried under debt. It had to pay soldiers, merchants, and allies like France. The first Treasury Secretary, Alexander Hamilton, chose to repay those debts through structured government bonds. The goal was not only to raise money, but to build credibility. It worked. As the government kept its word, investors kept lending. From that moment on, however, the nation entered a cycle, borrowing again to repay old borrowing. Bonds moved to the center of the economy. The creation of the Federal Reserve in 1913 changed the system completely. Before that, banking panics and financial crashes were common. The Fed was created to calm the system as a lender of last resort. Over time, it became not only a support for banks, but also a pillar supporting the state itself. During World War II, the government needed enormous spending. The Federal Reserve agreed to purchase government bonds to keep borrowing costs low. A permanent buyer for government debt now existed. If necessary, the central bank would step in. A major turning point came in 1971. Until then, the dollar had been tied to gold. Foreign countries could theoretically exchange dollars for gold. But rising spending and expanding debt weakened confidence in the currency. President Nixon ended the gold standard. From that moment on, the value of the dollar rested not on a physical asset, but on trust alone. Money was now supported more by belief than by metal. Today, the system works like this. The government issues bonds to cover its budget deficit. Banks, funds, and foreign governments buy them. When demand weakens, the central bank intervenes. It creates new money digitally and uses it to purchase those bonds. During the 2008 financial crisis and the pandemic, trillions of dollars entered the system this way. In other words, a significant share of government spending was financed with newly created money. To many people, this sounds impossible. How can a country buy its own debt? How can money appear from nothing? Yet much of the modern economy depends on this mechanism. Wars can be financed without raising taxes. Banks can be rescued during crises, and relief payments can reach citizens. It appears almost magical, but there is a cost, and that cost is usually paid not by governments but by the public: inflation. As new money is created, the value of existing money declines. Prices rise, savings erode, and wages fall behind. For this reason, inflation often acts like an invisible tax. There is another consequence: dependency. For decades, the United States has run deficits, and its debt has continued to grow. Foreign countries once financed much of this borrowing, but are becoming more cautious. Major buyers such as China and Japan are reducing their holdings. This means the country increasingly relies on its own central bank. More money creation, more inflation pressure, and greater risk if confidence weakens. This is not unique to America. Throughout history, major powers financed their expansion with debt. Britain built its empire on bonds but lost power after wars. 18th century France could no longer sustain its debts and was shaken by revolution. Debt can lift empires, but when trust disappears, the system collapses. America's advantage is the central role of the dollar in global trade. Oil, commerce, and reserves largely operate in dollars. This creates a loop that ties the world to U.S. debt. Yet growing gold reserves and the search for alternative currencies suggest that trust may not be permanent. Why does this matter to you? Because this is not a theory confined to economics textbooks. It affects your purchasing power, your bills, and your savings. Every time new money is created, the value of the money in your pocket declines slightly. Inflation becomes a silent transfer of wealth. From those who hold cash to those who hold assets, the system works as long as people trust the dollar and government bonds. But history repeatedly shows that trust can break. Excessive money creation has led to hyperinflation, currency collapses, and financial crises. Rising prices and fragile markets today remind us that these risks have not vanished. The greatest danger is not just inflation, but is the loss of confidence. If investors stop believing U.S. debt is safe, even more money would need to be created, shaking the global system. Then the issue would no longer be only economic, but historical. The fate faced by heavily indebted powers throughout time. That is why understanding this mechanism matters. It reveals how governments postpone difficult decisions by borrowing, and how the cost spreads across society. The problem is not political, but structural. The system is built this way. The lesson is simple. The monetary order depends entirely on trust. Government debt is not free, and inflation is a hidden tax. You must consider your own finances. If prices rise, will your savings endure? If the system wobbles, is your income secure? Because when the system falters, ordinary people, not governments, bear the cost. History does not repeat exactly, but it follows familiar patterns. Great powers grow through debt and weaken when trust fades. Today, America continues the same game, constant borrowing, purchasing its own debt, and believing it can last forever. But no system lasts forever. The only real question is when it ends. If this story changed the way you see the world, continue the journey with us. The answers are hidden between the lines of the past. Together, we will discover where to look.